Okay, maybe I will introduce myself first. I'm Jack. So one of the dealer from Phillip Security. Today I'm going to share about three type of asset classes to consider during rate cut. Rate cut, because we know that now US actually have announced their rate cuts on September. So what is the best asset class to look into right now? Can we still buy stocks, everything? Yeah. So today we'll cover about this thing. Okay, I think I will start the webinar right now. Okay, so before the webinar, let me uh, give you a disclaimer. So this webinar is solely for education purpose, not a buy and sell call. So let us start. So as we know that the US Federal Reserve just announced its first rate cuts of 0.5% at the September FOMC meeting. So what is our next move? What should we be investing in right now? Is is there a good time to buy stocks? In today's webinar, I'm going to break down the three winning asset class that historical perform really well when interest rate drop. But before that, what does a rate cut really mean and why should we care about it? The US Federal Reserve cutting its interest rate by 0.5% might sound like a small little change, but this is a really huge impact on the economics and the whole world will be affected. So it will cost the borrowing cost cheaper. So a cheaper borrowing cost, meaning that business can borrow more money to expand. And imagine that for the for the layman like us, if the borrowing rate is low, we can buy more house and car if the rate is low because we are able to borrow a cheap money. So in this case, consumer spending will increase too. So in a sense, we can see that actually rate cut is to stimulate the economy, to help the business to borrow more money to expand, for the consumer to buy more uh things to buy more things to boost the economics. So understanding the outlook for the future rate cut is really crucial, especially for investor like us. If we want to invest in US market, Singapore market, Hong Kong market, we need to know what is happening in the market, what is going on to the monetary policy by the US, because all this rate cut will affect the whole world, the market, and everything. So one of the best tool we have for understand the Fed expectation for future rate cut is the dot plot. So right now I will share the dot plot. So this one is to show the expectations of the FOMC member, which is the policymaker, what they anticipate for the rate cut. So you can see here, actually this year they are anticipating the rate cut is will stay around 4.5% to 4.25%, which is around two rate cut or one rate cut this year. So we can expect that actually from their dot plot, we know that they estimate this year will cut two times or one time. So in our heart now we know this year there will be around one or two rate cut, which will really affect what our investment strategy. Okay, so this dot plot is quite important actually. So we can see, if you can see, here is for 2024, and all one dot represent one member of FOMC. What is FOMC? So FOMC is the committee member to decide whether they want to increase their interest rate or not. So they are the member who can make decision. So one dot meaning by one member. So you can see the average point is at around 4.5 to 4.25% interest rates. So we can see that 2024 is around, right now is around one to two rate cut away. And looking ahead for the projection for 2025, we can see that actually um, the rate is around 3.25 and to 3.5% at 2025. So we can expect there will be more rate cut next year. Okay, by looking at this. So this evolving outlook not only help us to gauge the Fed monitoring policy direction, but also reveal potential opportunity in industry that typically thrive during periods of low interest rates. So now we know 2025 there will be few rate cuts happen, and this year there will be more one to two rate cut happen. So we need to be prepared. We so that let's say if the Fed is going to decrease their interest rate, we won't be like don't know what is happening and be prepared. And also maybe you already have some asset that are benefited from this rate cut. That's why we need to know what is happening. By this dot plot is a very good tools for us to predict and prepare for the interest rate cuts. So as we anticipate this change, it is essential to position ourselves strategically to take advantage of the favorable conditions created by this rate cut. So for this one will be a big pictures for the member, what they anticipating on the rate cut. And one more I can show you on the website is that the estimations of the market. So this one will be the probabilities for next FOMC meeting, what they're going to do. So you can look at this. Currently, the rate cut is at 4.75% to 5% the rate cut, the interest rate. In the next meeting, market anticipating 92% they will decrease one rate cut. So from the market, actually, their estimate next rate cut will be one rate cut, which is 0.25%. And we can look at this. If you guys want to know this website, you can check CME group. So you can follow. Because this estimation is always it will change over the time. It will not be fixed. So maybe next week you look at the percentage maybe is different. Maybe it's 100%, maybe it's 80%. So it depends on what market is anticipating on. So just now when I show you the dot plot is what of the member of the FOMC, what they think on the future rate cut. For this one will be probability for the market to anticipate what is happening next. Will the rate cut go 0.25%, 0.5%, or 0%? So we can look at this. If you are if anyone is interested, you can go into CME group to look at it. Okay. Okay. So next, according to the Fed, they will adjust the interest rate based on the economic data. The most important one will be unemployment rate and CPI, because the whole idea for increasing their interest rate is to tamp down the inflation rate and also to secure their economic. So right now, when last year, last 2 years, they increased the interest rate, they want the inflation to go down to 2%, and at the same time, economic go very strong. That's why they increase the interest rate. So right now, actually, as CPI is close to 2%, that's why they will decrease the interest rate because of the goal already achieved. And also, unemployment rate actually is going up significantly. And we can look at it on April, the unemployment rate actually is right at a 3.9%. But over the time, after September, we can see it's around at 4.1%. That's why rate cut is happening right now because US also see that the unemployment rate is going up gradually. So they're trying to prevent more unemployment rate going up. So if you guys got follow the news, we can see actually after the unemployment rates show up for 4.1%, the market actually anticipating lesser rate cut because of the thing that the unemployment rate actually is going down. That's why they think that the US economy is very strong. So there's not necessary to decrease the interest rate so fast and so fast. That's why you can see right now the market is anticipating for one time rate cut on November. But for me, I think actually this unemployment rate cannot really um say anything and cannot really tell that US economy is very good, because when we look at the unemployment rate, it is going down for 0.1%, which make the market happy. That's why you can see that the market is anticipating soft landing. We can see that. But for me, I think looking at unemployment rate is not really uh enough, because when we look at the unemployment rate, it's going down. But at the same time, we can look at the initial jobless claim. We can see actually on October, 10th of October, the result is actually going up a lot. So we can see actually a lot of people is claiming jobless claim. That's why we cannot realize depending just unemployment rate, but we can also look at it actually initial job claim is going up. So interest rate going down is I think is confirmed, and the economy is maybe not going very good. Okay, so last unemployment rate we can see is 4.1. So actually, and also I got one tip that can show you guys is when we look at the US economy, we can of course look at unemployment rate. When we look at that, if the unemployment rate go up 3 times in a row, that's actually show a red flag that actually US economy is not really good. That's why the Fed fund rate will go down, because they're trying to help that. All right, now we got a clear picture of the Fed outlook and what is mean for the economics. So it's time to talk about what should we invest to take full advantage of this rate cut. So all the asset class I talk about today will be benefit from the rate cut. So if the expectation of the rate cut is high, this trade asset will perform very well in the market. However, if the market expect that lesser rate cut will happen, like right now, the asset class will not be perform very well. So one of the reasons here is to invest in this asset class to diversify your portfolio to match the macroeconomic in the midterm. Okay, so let us move on to the first asset class we want to talk about is REITs. So lower interest rate allow REITs to finance new property acquisitions or refinance existing debt at a lower rate, making REITs one of the most top performing investment during a rate cut uh, environment. So let me show you how exactly why REITs shine when interest rate drop. Over the past couple of years, rising interest rate and inflation create a headwind for REITs. Property value corrected and investor pull back as higher financing costs make it more expensive to invest. So here's the opportunity right now. As the Fed move into a period of rate cuts, the environment become perfect for REITs for a comeback. Because lower interest rate mean cheaper financing costs for real estates, and that's when REITs go up, the price of REITs go up. While cash flow at the property remains stable, the drop in borrowing costs boosts property value, making REITs more attractive, especially now they are still trading in relatively cheaper valuations compared with the broader stock market, compared with the tech stock. If you can see, Nvidia is going to break the history high, but REITs is still actually at the not really not really high place at a cheaper valuations. So we already seeing a sign of a REITs rally as 10-year treasury yield begin to decline. REITs usually show a strong performance that there's a huge momentum. If we look at Vanguard real estate ETF, we can see it go up. Like, maybe I can show you the graph. So by looking at this, we can see that actually from July, the REITs ETF is going up from July. So this one is when the market is anticipating Fed is going to decrease their interest rate. That's why you can see the price go up more than 15%. So after that, when the market tried to anticipate a soft landing, a lesser rate cut, you can see rates go down. So the movement of the risk actually really depending on the policy of the rate cut. So if the market anticipating more rate cut, then rates will go up faster, going up more. But let's say the market is anticipating a lesser rate cut, you can see actually uh the ETF is going down. So this one VNQ actually is a ETF that track real estate. So the REITs ETF lah from Vanguard. So one of big company that have the ETF. So looking ahead as the Fed continue cutting their rates, REITs stand to benefit in two big ways. First, lower financing costs will drive their earning higher. And second, cheaper access to capital will allow REITs to go on the offensive, acquire property from private owners who may be under financial pressures. This position REITs to grow significant in the coming years. And the best part is that as rate cuts signal a bottoming out of real estate value, REITs are well positioned to take advantage of buying opportunity, and we could see a major upswing as this trend unfold. So I think if we talk about risk, a lot of people will ask, what should we buy? So what should we buy? In Singapore, I think a lot of company that is suitable. If you are interested on Singapore REITs, you can comment below. So next time we can do more Singapore REITs. Today, I will talk about one US REIT, which is we call it O. So O is a Realty Income Corporation. So it's listed in US. So O is the fifth largest global REIT in the world. One of the best part is that O is they pay a dividend monthly. So you can see here every month they will pay dividend. So this is one of the quite interesting platform for this REITs. Okay. And with over 15,445 commercial property under long-term net lease agreement, the company boasts a portfolio occupancy rate of 98.6%. So I think O is one of the REITs that we can look into because in terms of their fundamental is quite strong, and also they pay dividend monthly, so it's quite interesting lah. Not all the REITs company pay dividend monthly. Usually it's more on the quarterly basis. So looking at the technical analysis part, we can see that actually 63.33 is actually a strong resistance. So if the price breakthrough, I think a short-term breakthrough, we can go in if you are very aggressive, lah, of course. So we so if you are not so aggressive, I think you can look into the price of 59. So this is also a strong supporting level. If you are more conservative, I think the next support level will be 53 lah. So this trade will be my support and resistance level because for the short term you can look into the breakout right now because right now actually the resistance is quite, we can see there's a strong resistance. If breakthrough, then it's a short term opportunity, but if you are more on mid-term to long term, we can look into the cheaper price like 59 or 53, these two price. And also VNQ we can look into. So O will be one company and VNQ will be the ETF for it. So the price, the support level will be at 92 and the next one will be 88. So if you are interested, you can look into it. Okay. So now we have covered how REITs can capitalize on lower interest rates. Let's turn to another timeless asset that shine when rate cut falling. So which is a gold. So why does gold perform so well when interest rates cut? Historically, gold has been a good investment during period of economic uncertainty and decline interest rates. So when cost of borrowing drop and inflation's fears rise, investors often flock to gold as a safe haven to preserve wealth. So right now actually is the time because we can see that there's a lot of war happening around the world. Israel war, Russia that's having war right now. So the world is at an uncertainty period. Gold is something we can look into. And also US is cutting their interest rate, which will benefit gold. Why is it so? Why does gold perform so well when interest rate fall? It's all being a stock of value and a hedge against currency devaluations. So as interest rate go down, the return of traditional safe investment like cash and bond will go, the price will go down, which push investors to look for alternative that can protect their wealth. Like gold historically has been a safe haven during such time. And here's where it get more interesting. When the Fed cut their rate, it often will lead to a weaker USD. As USD is weakened, gold price, which is price in dollar, become cheaper for international buyer. So gold and USD actually is quite negative correlationships. When the USD weak go down, the price of USD go down, gold actually will go up. So we can see if the rate cut is going more intense, the US Fed is going to cut their interest rates. USD will go weaker and weaker because of the money will go outflow to others country because of interest rates. So in a sense, gold actually will benefit from the rate cut. Price of the gold will go up. So this relation between a weaker dollars and rising gold will make gold a very good investments for mid to long term. Maybe for me, everything will be mid-term because this one really depends on the rate cut. How long will it last? So gold actually is also an effective hedge against inflations as the Fed lower interest rate to stimulate the economic growth. Inflation concern actually will rise. When inflations erupt the purchase power of currencies, the investor will choose to buy gold to preserve their wealth. So historically, we have seen gold price surge when the real interest rate turn negative or remain low, making gold more attractive. The last time we see a significant rate cut, gold price actually climbed as investor look for stabilities. And with the Fed expected to continue reduce rate into 2024 and 2025, we could see gold price actually go up a lot already. In time of economics uncertainties or market volatilities, gold actually is a reliable asset for preserved value. I think a lot of people question will be now gold already go up to so high level. Is it okay to buy? For me, I think for the midterm, gold is something that we need to have some in our portfolio, in a sense of diversifications and in a sense of protecting your portfolio. So maybe we can look into the price of the gold right now and where is the support and resistance. I think a lot of people would say that gold is actually at a quite high price. Should you enter? I mean, for the long term, from the short term, maybe it will go down. But for midterm, actually, gold is something that we need to have for our portfolio. For investor, like if you have a huge portfolio, I think having gold inside a portfolio should be a very normal and is a must, lah, I think. You can have around 5% in your portfolio and it is very good and handy. You can see that. And let us look at the support and resistance for gold. You can see actually the resistance for gold right now actually is now around 2,678. So if this resistance had been breakthrough, short-term gold maybe have some opportunity. But of course, you need to break through this resistance first. But for short term, for for midterm, I think that the best price will be 2,400. 2,400 will be a relative cheaper price and have more opportunity. Of course, if you like gold more, I think 2,600 is the first support level. But for me, I think I will look into 4,000, 2,480 something around here will be a quite decent price to get into. Yeah. Okay. Let's move to next. So now that we have covered REITs and gold, let us move on to the third asset class that really benefit from a rate cut environment, which is bond. So bond often see as one of the most straightforward way to capitalize on rate cuts. And with interest rates set to fall, they're about to go up. So why do bond perform so well when interest rate drop? The key lie in the inverse relation between bond price and interest rates. So bonds are really sensitive to interest rates. The bond price actually mainly affected by the interest rate. When interest rate go down, the price of bond will go up. So why is it so? Let me give you explanations on why the bond price always have a negative relationship with the interest rate. So let us look at here. So if on January you buy a bond that have a 4% yield, which give you 104 USD. Okay, so this is on January. So if let's say Federal Reserve there increase their interest rate to 5%, so the bond from February, issue from February will give you 5% yield. So you will get 105. So in this case, if you can look at it, for people who buy the bond on January will actually not really happy because you get 4%, but on February if you buy, you get 5%. So if you're having a January bond, you want to sell at the secondary market, okay? At the secondary market, you actually nobody will want to buy your bond with 4% because right now the the yield is 5%. So you need to discount your price to sorry, you need to discount your price to 98.8 to match the current yield 5%. Okay. So in this case, if the interest rate go up, your price, your bond price will go down. And in the same, in the other hand, if the yield go down, the price of bond will be go up because the the bond you having is having a more yield compared with right now. So the price of the bond will go up. Okay, hope you guys understand on this explanation. Anything, feel free to comment. Okay, so let's go to the next. Okay, so when we talk about bond, now we know that actually rate cut is happening. Rate cut and if rate cut is going on, so bond actually is something we always uh want to have it on this environment. But of course, bond, a lot of people will say that the capital requirement is very huge. For US bond, there is minimum $200,000, you only can buy one bond. And for Singapore, it's $250 Sing dollar to get one. That's why a lot of people will not consider. And also you need to have a credit investor's title to buy bond. So I think bond maybe is not so suitable for most of the investor that has not much capital. Like me, I also don't have 250,000 to buy a bond. But we can look into ETF, bond ETF actually save a lot hassle and give us the accessibility to buy bond. Okay, so buying bond you can be less liquid and sometimes it's hard to trade because bond don't have a ready market like a ready market like stocks market. Bond do have secondary market, but it's a uh over the counter. So the liquid and the volume is really low compared to stocks. So you cannot like today you want to sell, maybe take some time for the bond to sell it. But if you look into ETF, bond ETF actually uh you don't need to have a huge capital and the volume is very high because it's traded in stocks market. So investor like us with smaller capital might find it challenging to buy bond, but purchasing ETF is more suitable for us lah. That's why today I'm going to recommend bond ETF like TLT and TMF that are traded in stocks market. So we can easily buy and sell them during market hour, just like stocks. Not only do they require less capital, but they also offer easy access to the bond market, making them an ideal options to the most investor looking to profit from the decline interest rate. So traditionally, when you hold a bond, you are looking for the yield, you are looking for the dividend from the bond. But to invest in the bond ETF, actually we are looking for the price appreciation. So let's say the interest rate go down in a short period of time, like 1 month, 2 months, then the bond ETF will go up their price. So let us look at the one of the bond ETF I'm looking at, which is TLT. So TLT, the underlying of this bond ETF is US Treasury bond, 20 years, having 20 years US Treasury bond. So the yield to mature is around 4.19%. So why do we choose TLT? Because TLT is backed by the US Treasury bond, which are considered one of the safest investment due to this. It's very hard for US government to go bankrupt, right? And until now, US actually has not defaulted on their debt. So treasury bond actually is known as a risk-free asset. And now we are buying this, so it's more on conservative part. Okay. And one of the best part, why do we choose TLT? Because TLT itself is 20 years treasury bonds. So not everyone have the capital. And the price for TLT right now actually is one ETF is around $95. So it's really convenient for people who want to buy. So if you are anticipating on the rate cut, you think that the rate cut going to happen more frequent? You think that this year 2024, US going to cut more than 2 times, 3 times, or 4 times? Then bond this TLT is something that we need to look into. Because when the interest rate go down, the price of bond will go up. But let me show you the TLT. Then you have some idea on that. And how it work is actually based on expectations, the expectations on the rate cut. So we can see actually from April, this bond ETF is going up around 40%. So this is because the market is actually anticipated that US will cut their rate. That's why it go up. Then after the US actually cut their rates, right? Cut their rate by 0.5%, the market actually anticipated the US going to cut rate lesser and slower. That's why the price of bond go down. So actually, if you look into TLT, you will have a question: why Fed already decreased the interest rate, but TLT is still going down because of the anticipations on the rate cut. The market think that this year there will be only 1 to 2 time rate cut, so the TLT actually is go down lah. And this one actually also based on the 20 years yield curve. So we can see. So if you want to invest on the bond ETF like TLT, this one really rely on the market expectations on the rate cut. So let's say when will this TLT go up? So when the unemployment rate go up a lot, like let's say today the unemployment rate is 4.1%. Next month the unemployment rate go up to 4.3, 4.4%. Then you will see TLT go up a lot because the market will anticipate that, oh, economy is not good. So US Fed will trying to decrease their interest rate to stimulate the economy or to prevent more worst case scenario will happen. That's why TLT will go up. So everything, the movement of the TLT will solely rely on the expectations on the market, on the interest rate, and also economy. Because economy is the most important part that Fed will either decrease the interest rate or stay at this level. If the economy is not very good, then it's likely that US will go more rate cuts on this year. So this one will be a TLT, and the second one I want to introduce will be TMF. So TMF will be because maybe TLT people will think that, oh, 14%, 15% is quite slow. If if you want more you are more aggressive and you want to seek for more upsides, you can look into 3-time bond ETF, which we call TMF. So this one will be TMF will be the time 3 leverage ETF for TLT. So whatever TLT move, like 10%, TMF will move 3 times of TLT. So this one is for people who has more risk appetite. If you are risk averse, you can look into TLT because when we look in TLT, right, it actually go the price of it's not that volatile you can see. So you can see on April, the price is at 87. So for 2 years time, 2 months time, it go up around 14%. So if you think that this is a good percentage, you are comfortable with this, then you can go for TLT. But if you think it's too slow, then you can look into TMF. Okay. So why do I recommend leverage product, like 3 times leverage product? Because for TLT, I think that the downside of TLT is limited. It is very hard to go down like $80 because of the underlying of this is backed by the US Treasury bond. So the yield will not go up so much, which cause TLT go down. The price of TLT will go down. So TLT actually have a limited downside, but potentially more upsides. That's why we look into the leverage products. But if you are risk averse, definitely you can choose TLT. TMS is a three time ETF, which given leverage and can generate more return during the period of aggressive rate cuts. But the leverage structure, of course, you need to bear more risk, and it could lead to more losses like if the rate cut never happen. Okay. So if you want to invest, of course you need to handle with care. So when the Fed cut interest rate, it create a unique opportunity for investor like us to position themselves for potential gain. REITs, gold, and bond are three asset class that historically perform well in this environment. This investment can help you to navigate and profit from rate cut. So here will be our end of the webinar. Feel free to ask any question if you have one. So today we talk about REITs, gold, and bond ETF, which I think that it will benefit from the rate cut. So these three asset class I recommend will really based on the interest rate environment. So let's say US now suddenly they don't cut their rate anymore. The rate will remain at this level for long, for 1 year, 2 years. Then all these three asset class will not be perform very well. Of course, gold itself is a different story because gold, one of factor that affect gold is also the world and economic uncertainty. If there's more war happening, then gold actually may go up more. But for bond ETFs, definitely they are really rely on the interest rate. So let's say tomorrow US suddenly announced that they will cut rate for 2 times or 3 times. Definitely TLT will go up a lot, the price. So TLT really solely depending on the interest rates and interest rate policy. Diana Tan. Okay, so to answer Diana Tan questions, there's one question. How many percent should be at our investment portfolio for ETF and bond for aggressive investor? Usually for TLT, right? For the bond ETF, we always look into 10% or lesser for your portfolio. So 10% will be more than enough, I think, for TLT. If you are using TMF also you can get a lower percentage, but 10%, around 10% will be good. 10%, or go also around 5 to 10%. And of course, you need to have some cash on it. On ask which gold ETF would you recommend? Gold ETF definitely will look into GLD. GLD is one of the biggest ETF by SPD. Yeah. So you can look into GLD. Yep. Usually GLD have more volume and you won't see so many gap on it. Yep. Hope I answer your questions. So back to the slide. So before we end, we do have our CFD welcome gift right now. So if you open an account with us, you can get a PLTR CFD shares on it. And if you fund in, you can get more shares. So maybe you can scan the QR code to learn more. Feel free to scan. Okay, maybe I give you guys 1 minute to scan it, then we'll proceed with other questions. Yeah, you're welcome on. Oh, sorry. So we can look into that. If you open a Poyum CFD account with us, you can get a PLTR CFD shares, which is cost around $40, I guess. And if you open CFD account and trade 1.5 million in CFD contract value, you can get a TSM shares. And if you trade 4.5 million in a contract value, you get Microsoft CFD. So in CFD is high leverage, so is quite easy to get 1.5 millions in a CFD contract value. You guys can know more detail by scanning this QR code. Yeah. And also you can look into the link if you want to have it. So any more questions? I will give 5 minutes. If nobody will end the webinar. Feel free to ask any question. Oh, I can see that there's some question. Should buy 20 years bond ETF or 7 to 10 years? Okay, so this is an interesting question. So why do I choose 20 years ETF instead of 7 to 10 years? Because the longest years bond will actually more sensitive to the interest rate. Okay, because if you are having a 20 years treasury bond, you are more sensitive to interest rate because when the interest rate go down or go up by 1%, it will affect you for 20 years. But if you have 7 years treasury bond, the interest rate will affect you 7 to 10 years. But if you get 20 years, it will affect you 20 years. So 20 years bond will more the price will more sensitive than the 7 to 10 years. That's why we look into the longest years to get more price appreciation, to get more percentage. Yep. Which is better option to buy GLD in US or SGD. So if you ask me which one do you is good to buy, whether you are using USD or SGD, it really depends on your preference because sometimes for me maybe USD is good because GLD in USD is more volume and also easy to access. And I do invest in some US stocks. That's why having a USD for me is okay. But if you don't invest in USD and you don't need USD, then you may look into SGD lah. Because it really depends on your personal preference. For the GLD listed in US, in USD is more volume and there's lesser gap you can see and you can trade during the US hour. But if you buy gold listed in SGD, you can trade in Singapore hour. That's the good thing. So for people who don't like to trade overnight, midnight, then you can look in SGD. But you can see actually the one listed in SGD, gold listed in SGD, actually there will be some gap lah because the night market is trading, but SGX will close. So really depends on you. And if you don't really use USD and you don't like to have those currency conversion, then SGD is something you may like it lah. Will recording be available? Yes, there will be a recording. And maybe I can show you the gold ETF listed in SGX. If I never wrong, 087 should be the one. No, 087 is not the one. I think go SGD. Go SGD. Let me check for you. Which one is the gold ETF listed in SGX? Gold listed in SGX. Oh, GSD will be the one. GSD. If you are interested in GSD, will be the one. GSD. Yes, thank for FS phone. So you can say actually more or less the same GSD but this one is listed in SGX, trading in Singapore time, and currency is at SGD. So if you don't like to do a currency conversion and everything, you don't want to have USD, and you want to trade in Singapore time, then you can go for GSD. if you are okay with trading in US time, having USD, then you can go for it. But because GLD usually have more volume, so it's more easy for you to buy and sell. Sometimes in Sing there's not much volume lah. Okay, can use. Yep. So for the presentation slide, we'll be send we'll send you an email with the webinar link record lah. So we can look into. Yep. Okay, so I think this will be it. Any more question? If no, then we will end the webinar. Thank you very much. Goodbye, everyone. Hope you have a good night. Thank you. Thank you, Derek. Thank you. Thank you, everyone.